Welcome to the deep dive. You've asked us for a guide, maybe like a map, through what can feel like a really dense jungle of jargon.
Huh.
The stock market.
hmm
You want that solid base, that quick way to feel confident so you can actually understand what's happening, read the signs, maybe spot an opportunity.
And that's exactly what we're aiming for today. Often, the biggest barrier isn't how complex things are, it's just the vocabulary feels intimidating.
Right.
So yeah, we're doing a jargon-busting deep dive, but more than just definitions, we want to give you the why, the context, what it means for you.
Perfect. Okay, before we get into owning stuff, let's just quickly clear up something people often mix up. Stock market versus share market. They sound the same, but not quite, are they?
No, they're not, and it's good to know the difference in scope. Think of the stock market as like the whole big department store. It trades all sorts of things: bonds, derivatives, funds, and yes, shares.
Okay.
The share market or equity market is like one specific department in that store. It's focused only on the shares, the stocks, units of ownership.
Ah, got it. So the stock market is the whole supermarket. The share market is maybe the fresh produce aisle, a really important aisle, but not the whole store.
Exactly. A great analogy. And today we're focusing mostly on that produce aisle, the shares, and the words you need to navigate it confidently. So our mission: unpack the key terms around ownership, value, how trades work, and market moods.
All right, let's start right at the beginning. If I say I own a share or a stock, what do I actually have?
You physically, well, digitally these days, hold a piece of ownership in a company, a unit of equity.
Okay.
So buying a share makes you a part owner. And if it's common stock, which is what most individual investors buy, you usually get voting rights too, on big company decisions.
Right, like electing the board.
Exactly. And importantly, if the company makes a profit and decides to share it, you might get dividends.
And why do companies go through all this hassle, going public? It seems complicated. Is it just about capital formation?
Primarily, yes. It's all about raising money, capital for growth. Instead of borrowing and taking on debt, they sell these little pieces of ownership to investors like you.
And use that cash for
What?
building new factories, research?
Precisely. Expansion, R&D, maybe buying other companies, it fuels major growth.
Okay, that makes sense. So a share isn't just born on the trading screen. It has a life cycle, starting in the primary market.
That's right. The primary market is the birthplace. A private company decides, okay, we're going public. They issue shares for the very first time through an initial public offering, an IPO.
Ah, the famous IPO.
Yep. Usually handled by big investment banks, very regulated process.
So the IPO is like the debutante ball for the stock. Once it's had its big intro, where does it trade day to day?
Then it moves over to the secondary market. And that's the market most people mean when they talk about the stock market. It's where investors like us buy and sell existing shares from each other.
Through places like the NYSE or NASDAQ.
Exactly. Those are the big stock exchanges in the organized marketplaces. And you, the investor, usually go through a broker to actually make the trade happen on the exchange.
Gotcha. And while we're on basics, we hear blue chip stocks mentioned all the time, usually suggesting safety or quality. What makes a stock a blue chip?
Think of them as the established giants, large, financially strong companies with a long track record of stability, maybe paying dividends reliably. They're well-known, often household names.
So, like the veteran players on a sports team. Proven performers.
That's a good way to put it. They're the dynasty teams of the market, often the core of a more conservative portfolio. Maybe not the fastest growth, but generally seen as more dependable.
Okay, so we know the stock exchanges match buyers and sellers. But let's get practical.
Yeah.
How do I actually buy a share, and how does the price get decided right then and there?
Well, your broker is key. They're your agent, your connection to the exchange. You tell them, buy 100 shares of company XYZ, and they execute that order for you.
And the price, it's not just fixed, is it?
Definitely not. It's a constant negotiation, purely based on supply and demand happening in real time. Millisecond by millisecond, really.
Right, okay. So there's always a highest price someone's willing to pay right now. That's the bid price.
Correct. And at the same time, there's a lowest price someone else is willing to sell for the ask price.
And the gap between those two.
That's the bid-ask spread. A
Yeah.
really small spread usually means lots of buyers and sellers, lots of activity. It's efficient.
And a wider spread means it's harder to trade, less liquid.
Exactly. Or maybe just less interest in that particular stock at that moment. The spread is also important because it kind of represents a hidden cost of trading or the profit for the market makers facilitating things.
Okay. Now, when I place my order with the broker, I have choices.
Yeah.
About how I want to buy. It's about speed versus price.
Precisely. The simplest is a market order. You're basically saying, get me in or out right now at the best price available.
So speed is guaranteed, but the exact price might wiggle a tiny bit.
Yeah, especially if the market's moving fast. You get it done quickly, but maybe not at the exact price you saw a second ago.
And if I do want control over that price,
Then you use a limit order, you set your price. I will only buy the stock at $50 or less, or I will only sell it at $55 or more.
gives you control.
Total price control. But here's the catch. If the market price never reaches your limit, your order might just sit there unfilled. You prioritize price over certainty of execution.
Okay, that makes sense.
Yeah.
And whether my limit order gets filled or how easily the market order goes through, that ties into liquidity, doesn't it? Hear that word all the time.
It's crucial. Liquidity basically means how easily and quickly you can buy or sell an asset without drastically moving its price.
So high liquidity is good. Means lots of action.
Very good, generally. It means there are plenty of buyers and sellers around. You can get in and out smoothly. We often gauge this by looking at trading volume, just the raw number of shares changing hands. High volume usually means high liquidity.
All right, we know how to buy. Now, how do investors figure out if a company is actually, worth buying? First up seems to be size, market capitalization, or market cap.
Yep, market cap is the basic measure of a company's total value in the eyes of the market. Super simple calculation. Just the current share price multiplied by the total number of shares out there.
And that helps categorize them. Large cap, mid cap.
Exactly. It gives you a quick sense of scale, large cap being the giants, small cap, smaller, potentially riskier, but maybe higher growth companies. Helps investors frame risks and potential.
But big doesn't always mean profitable, right? A huge company could still be losing money.
Absolutely critical point. Size isn't everything. You need to know if the company is actually making money for its owners.
Which leads us to earnings per share, EPS.
EPS,
Yeah.
one of the most fundamental metrics. You take the company's total profit, its net income, and divide it by the total number of outstanding shares.
So it tells me how much profit belongs to my single share.
Precisely that. It boils profitability down to a per share level. Very important.
And investors take that EPS and use it for probably the most famous valuation metric ever. The price to earnings ratio, the PE ratio.
The PE ratio. Yes, it's everywhere in fundamental analysis. You just take the current share price and divide it by the earnings per share, EPS.
Okay, so what's it telling me? If I see a PE of, say, 50,
It's telling you how much investors are willing to pay today for every $1 of that company's current earnings. So a PE of 50 is high.
meaning high expectations.
Massive growth expectations. Investors are paying a big premium, essentially saying, we believe earnings are going to grow dramatically in the future. Think high-growth tech stocks often have high PEs.
But the risk is.
The risk is huge. If that growth doesn't materialize perfectly, the stock price can get hammered because you paid for future hope, not current reality.
Okay, and the flip side. A low PE, maybe like 8. Is that automatically a bargain?
Well, that's the million-dollar question. It could mean the stock is undervalued, overlooked by the market, a hidden gem. Or it could mean the market thinks the company's best days are behind it. Maybe it's in a slow-growth industry or facing real problems. Distinguishing between a value trap and a true value stock is, well, what analysts try to do.
Gotcha. We mentioned dividends earlier, the profit payouts. How do we measure that income stream?
That's where dividend yield comes in handy. It takes the total annual dividend per share and expresses it as a percentage of the current stock price.
So let's compare.
Exactly. Compare the income from the stock to, say, a bond yield or a savings account rate. Really important for income-focused investors.
So we have these value metrics like PE,
Yeah.
but they're always bouncing around because of the market's overall mood, right? The
Right.
animal spirit.
Absolutely. Market sentiment is huge. When everyone's optimistic, prices are generally rising, the economy feels strong, that's a bull market, just a sustained upward trend.
And when things turn sour, pessimism spreads, prices drop hard.
You enter a bear market, often defined technically as, say, a major index falling 20% or more from its recent peak. These cycles are pretty natural, though painful, and they really underscore the idea of volatility.
Right, volatility. Let's nail that down. It's about how much and how fast prices swing up and down.
Exactly. The degree and frequency of price changes, a highly volatile stock is making big, rapid moves. Could mean high potential reward, but definitely high risk too.
It's like the market's heart rate.
Good analogy. Sometimes it's steady, sometimes it's racing. Think about those meme stocks recently. Huge jumps, then crashes. That's extreme volatility. The underlying company might not have changed much, but sentiment sure did.
So to get a sense of the whole market's health, not just one stock, we look at market indices.
Yes, indices like the Sensex, the Nifty 50 here in India, or the Dow Jones, DJIA in the US, they're basically statistical averages.
Like a snapshot.
Exactly. They track a basket of representative stocks to give you a benchmark for overall market performance, or a specific sector. Index up, market's generally doing well.
Okay. Given all this bulls, bears, volatility, how do investors actually try to manage the risk? Diversification seems key.
It's fundamental. The old don't put all your eggs in one basket idea, spreading your money across different types of investments.
Called asset allocation.
Right. Investing across different asset classes, things like stocks, bonds, maybe real estate, even just holding some cash. The idea is they won't all move perfectly together. When stocks are down, maybe bonds are up, cushioning the blow.
Makes sense. What about timing when you buy? It feels impossible to perfectly time the bottom.
It pretty much is. That's where a strategy like dollar cost averaging or DCA comes in. It's more about discipline than prediction.
How does it work?
You invest a fixed amount of money at regular intervals, like, say, 5,000 rupees every month into a particular stock or fund, no matter the price.
Regardless of whether the market is high or low.
Exactly. When the price is high, your fixed amount buys fewer shares. When the price drops, that same amount buys more shares. Over time, it lowers your average purchase cost, and crucially, it takes the emotion out of trying to time the market perfectly.
I like that. Okay, let's quickly cover direction. If I buy thinking the price will go up, that's simple, I'm going long, right? Bullish.
That's the standard way. Buy low, hope to sell high. But if you're convinced the price is going to fall...
Then you can do that tricky thing. Going short? Short selling.
Exactly. It's counterintuitive and definitely higher risk. You essentially borrow shares you don't own from your broker.
Okay.
Then you immediately sell those borrowed shares on the open market, hoping the price is currently high.
Right. Sell high first.
Then you wait. If you're right and the price drops, you buy the same number of shares back at the new, lower price.
And then you return those cheaper shares to the broker you borrowed from.
Correct. Your profit is the difference between where you sold high and where you bought back low, minus fees and interest, of course.
Wow. That sounds risky.
Okay.
What if you're wrong and the price goes up?
That's the danger. If you're long, the worst that can happen is the stock goes to zero, you lose your initial investment. But when you're short, the stock price can theoretically keep going up forever.
Oh, wow.
You still have to buy it back eventually to return it, so your potential loss is, in theory, unlimited. Not for the faint of heart or thin of wallet.
Definitely not. Okay, one last thing for people looking at charts. 2 basic technical tools to cut through the daily noise.
Sure. A common one is the moving average. It smooths out the day-to-day price fluctuations into a single line on the chart.
Helps see the trend.
Yeah, helps identify or confirm the underlying trend. Is the price generally staying above its moving average? That might suggest an uptrend.
And the other one, the 52-week range.
Simple, but useful. It just shows the absolute highest price and the absolute lowest price the stock has traded at over the past year.
Puts today's price in context.
Exactly. Is it near its high? Near its lows? Gives you a quick sense of its recent extremes and potential volatility. Useful for judging potential future moves. Hashtag tag outro.
Wow, okay, that was quite the tour. We've gone from what a share even is through IPOs, bid-ask spreads, PE ratios, market moods, all the way to short selling. That's a lot of ground covered.
It is, but hopefully you now have that core vocabulary, enough to understand financial news, company reports, and just feel more confident engaging with the market.
Right, the confidence is key.
And remember how you use this knowledge, whether you focus on dividends, chase high PE growth, use dollar cost averaging, it all depends on your personal goals, your time horizon, how much risk you're comfortable with.
Absolutely. So as you watch the markets do their thing, the bull runs, the inevitable bear phases, the volatility, it's maybe helpful to remember the big picture. This whole system exists to funnel capital to companies doing things, innovating.
That's its core function.
And despite all the daily drama, historically, the stock market overall has generated wealth for long-term investors. That average annual return figure you often hear, around 10% globally over long periods, well, that's the potential prize.
Mastering the vocabulary is the first step.
Yeah.
Mastering the discipline to stay invested for the long haul, well, that's often the real challenge, but potentially the most rewarding.
A great final thought. Thanks for breaking it all down.
My pleasure. Until next time.
अगर आपको वीडियो पसंद आया हो तो लाइक, शेयर और सब्सक्राइब जरूर करें।